Hey everyone, me Kevin here. Something big is about to happen, and there's some data that you need to know about that gives us a heads up on what it is. Now, let's first talk about why something big might be happening. First of all, we are at insane levels of uncertainty in the market right now. We have the potential for a counterstrike by Israel against Iran. We believe that Israel is going to strike Iran's nuclear facilities, to which, of course, Joe Biden says, no, please. Measured response. How about sanctions? How about anything but more conflict before the election? I'm already known for warmongering. So obviously politics is playing a little bit of a role here, but the Biden administration has made it clear. They do not want Israel to heavily counterstrike Iran. Ideally, no counterstrike at all. Like, can we let bygones be bygones? Probably not. It's the Middle East, after all. On top of that, you've got the port strike. Now, the Biden administration here is also like, hey, can you just pay the workers more money? Come on, we don't want a strike on our hands, and we need the union votes. So these things create alone substantial uncertainty in markets, but they're obviously not the only things that we're facing. The issue is that a counterstrike by Israel in the Middle East likely has the odds of raising oil prices even more. We've already seen oil prices rise as much as 5% yesterday. Today, oil prices were up as much as 4%. But as soon as Biden started encouraging a chill out, we actually saw oil prices retrace back. But the concern with higher oil prices is, of course, higher inflation. Now, we'll talk about my opinions on this inflation issue in a moment, but that's the concern. Oil prices, transport prices go up, and therefore costs of goods sold go up, and companies have to pass on the cost to somebody, and it could be the consumer. But it's not just that, because components of producer prices do also show up in the Fed's preferred inflation gauge, the personal consumption expenditures gauge, which takes from both CPI and PPI. Okay, great. So yes, oil and gas prices, even though they're part of the non-core numbers, can affect downstream inflation. It's not good. Obviously, having a port strike is another thing that may increase inflation for shipping rates, though in a weird way it actually might lower oil prices, because if you have ships sitting anchored without using fuel, they're just waiting to get unloaded, then you're not creating necessarily energy inflation, but you are likely creating supply chain snarls, and those supply chain snarls could lead to, you guessed it, inflation. Now, the real question that everybody has on their minds is, okay, we know about these two uncertainties, and so the real question comes down to how long. Now, what's fascinating about how long is what it actually leads to. How long is the fact that this already has been known by industries as both of these, frankly, being a problem since, frankly, the Red Sea and the Houthis and Israel and Iran has been a problem since October of last year. Red Sea issues we've already known. You've got to start ordering earlier. But the port strike issue really became an issue when the Longshoremen's Association went cold turkey back in June after rejecting the first offer. And of course, we had some recent late night negotiations before the expiration of the contract that didn't work out. Longshoremen, I believe, are now maybe down at 66%, down from their mid-70s. Who knows? And the Maritime Association, or whatever, they're somewhere at 50%. So we're getting there in terms of wage gains over a 5-year contract, but we're not there yet. So we've known about this since last year. So this is less of a problem. This right here we've known about since June. Now what's interesting is June is, frankly, if you look at the data, June was probably the slowest portion of our economy. This is when in June and July, we really started seeing restaurants get hit. We started seeing earnings at consumer good companies get hit. And it ended up leading to one of the lowest labor reports in August, which just left the market kind of looking a little poopy-doopy. Wasn't good. Now, interestingly, since then, we've actually been climbing back from the bottom. Well, maybe. See, the September readings that we've gotten for things like the job openings and labor turnover survey, the ADP report, the jobs report will probably get Friday. Some of the information that we've gotten in terms of ISM reports, PMI reports, outside of manufacturing, we've actually seen some good things. We've seen lower inflationary prices on certain items, like a report this morning, prices paid way in the toilet in the manufacturing business. But we're seeing real slowdown in manufacturing, not so great. But services picking up a little bit, retail sales picking up a little bit, GDP picking up a little bit. It's almost like some things feel like they're starting to pick up again a little bit. But is that pickup fugazi? Now, why would I say that pickup is fugazi? Well, it's possible that because we knew this problem was happening, this port strike was coming as of June, that we started placing more orders for whatever, hiring temporary staff for the holiday season, getting our goods and services in place before the holiday season. When do you do that? Well, probably the end of Q3 is a great time to maybe start getting your shipments situated. So there is a belief that potentially some of this recent bounce that we've seen may be in anticipation of the port strike. And so this then has created a very fascinating dynamic in markets right now. Since the Federal Reserve gave us a surprise 50 basis point cut on the same day, just 17 years later, as the 2007 50 basis point cut, which of course led to the stock market rallying for 6 weeks and then crashing 52% over the next year, what we've actually seen is something very, very strange. We have seen 10-year Treasury yields go up, which is very odd because you start this cutting cycle and you've actually seen the 10-year Treasury go from about 3.62 all the way up to about 3.8. Now, you might not think that's a big deal, but what it actually does is it tightens financial conditions more. And so a lot of folks, they look at this and say, okay, well, this is probably because a lot of bond traders had a lot of profits here, so they took profits. That's true. It's also potentially because the port strike actually happened. And we have this inflationary fear because of the Middle East. These are all things that could drive up inflation expectations. Oh, and golly, what do you think is happening right now? Inflation expectations bottomed in September, and they've started ticking up again. I'll read you the exact number right now so you can have a little bit of relativity in terms of where we sit. But that's not the only thing we've got to talk about here, because there's some important stuff coming up here. 2.21 is where we sit right now. If you go to September 10th, it's my dad's birthday, you are at 2.03 on the 10-year break even leading into the Fed meeting. And that is down from the top over in April of 22. So 422.22 I'll put. I should really just call that 420, but it was 420.22. And over here at this date, you were sitting at about a 3 handle on inflation break-evens. Usually you want inflation break-evens to frankly be like right or just above 2%. Mostly because usually with inflation break-evens slightly above 2%, you end up averaging 2%. The consumer goods economy and goods and services make up about, the consumer makes up about 70% of the economy, blah, 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 blah. This is why they want wage gains to be a little bit above the rate of inflation as well. That's all normal. Okay, so inflation expectations have gone up. Interesting. Okay, so what has happened, though, with bonds, and what are volatilities telling us right now, and what does that mean in terms of what's going to happen next? Well, something that I shouted out to course members today, which is very similar to what I did with Tesla, although I don't know what's going to happen now, but the last time I shouted out a historic volatility chart was right before Tesla went from 175 to 250. We looked at the chart, we go, oh my gosh, this has only happened 4 times over the last 10 years. Pay attention to this. And sure enough, within the next 4 weeks, Tesla was at 250. It was crazy. Absolutely remarkable. You could actually still go back and watch that course member live stream. I called it one of the most important course member live streams ever the day I posted it. And remember, you can always get lifetime access for those course member live streams by going to meetkevin.com. We have a coupon expiring this Friday. Any course, by the way, gets access to the course member lives. But what are we seeing right now? Well, if you look at something like a ticker TLT, and you pull up the historic volatility chart for it, or even the 10-day volatility chart for it, you're going to find something very interesting. You're going to find that volatility right now on the 20-year bond has not sat this low since October of 23, maybe September of 23. April, I want to say, 04, 24, April to May, it was in that range, like towards the end of April. And right now, today. So this is based on 10-day historic volatility. We have not seen, which the chart usually looks something like this. You know, usually you get stuff like that. We have not seen, what is that? I see something white right there. I want to get rid of it. Can anybody help me spot what that is before we talk about what's going on over here? Nobody knows what that is. Oh, is it this? No. Oh, it's the light. We found it. We have finally found it. There we go. Sorry. Little things like that bother me. Still see it a little bit. Oh, well. What does this mean? Well, it means that usually when bond volatility falls this low, we don't stay there. That, in my opinion, is a sign that something is about to happen. But first of all, what happened at these 2 points? Okay. Well, what happened at these 2 points was very interesting. October 23. Can anybody remember what happened with bonds in October of 23? You should know this. There's this person called Bill Ackman. He's a hedge fund dude, and let's just say he likes to talk his book. Let's just say during COVID, during the crisis, he went on TV with some delicious out-of-the-money puts on the stock market, presumably, and turned a few $1 million wager into a few $1 billion, because right after he goes on CNBC, he goes, we need to shut everything down for 30 days to stop the spread. Like literally shut everything down. The people on CNBC were speechless. Frickin' market tanks the entire week. Then you get October of 2023. What happened in October of 2023? Folks, it was the great bond short. Yes, the Bill Ackman bond short. If you remember, the 10-year Treasury yield literally ran up from about 4.3% on the 10-year, and Bill Ackman screaming, going, we're facing stagflation, this is really bad, everything's going to hell, this is horrible, oh my gosh, there's so much inflation, they're never going to get it down. What happens? He goes, 10-year yields are going to blow past 5%. And it's like out of a movie, my friends. Treasury yields on the 10 go literally to about 4.99, maybe 4.95. Yeah, I don't even know if that looks like a 990. There we go. Let's cut off a little bit there. 4.99. And he literally posts, covered. Now, in case that isn't clear what that means, it means he went short here. And when you're short bonds and yields go up, you make money, right? Because the bond is losing value, so the yield goes up. And as soon as it gets to 4.99, it doesn't even go through 5, even though he's like, it's going to blow past 5. The sucker covers. And he goes, you know, at this point, the value was just too good to be true on the Treasury bond. You know what? Legend. So what promptly happened after that? Yields went beep. So people are like, oh, Bill Ackman can't move the market. Line up his tweets. Yes, he can. The market ain't as big as you think. Kind of scary to think about it that way. People are like, oh my God, the shorts are manipulating the markets. It doesn't take a lot of money to manipulate the markets. I don't think so. I've gotten a little jaded. Forgive me. Maybe I'm becoming too in tune with what market dynamics look like. But I've gotten a little jaded. So yes, Bill Ackman can move the market. So think about that for a moment. Holy crap. Wait, so that's when bond market volatility was at its lowest? Yeah. Because it basically just was going up in a straight line, and it didn't have a lot of movement, and then it kind of just slowly went down in a straight line. And see, volatility doesn't come from that. That is not volatile, because if you take the first derivative of this, you have a flat line. Now, how does this look for volatility? Take the derivative of that. It's going to be a whole lot noisier than straight up or straight down. So, why do I bring that up? Well, because the second time we had such a low in bond volatility was in April of 2024. Well, wait. Bill Ackman didn't do anything in April of 2024. No, what happened in April of 24? Think about it for a moment. What happened in April of 2024 that was unique, that would make bond volatility be so low? Well, I mean, it means they were going in one direction. Yes, bond yields were going up. Why were they going up? Oh my God, we had a full quarter of high inflation. January, February, March. Oh, second wave. Yeah, everybody was worried about, oh my gosh, we've now had a full quarter of higher inflation. January, February, March. January, they're like, 1 month doesn't make a trend. February, 2 months doesn't make a trend. 3 months, oh, okay, that's a trend. Market actually fell in April too, the stock market, on this whole second wave of inflation fears. So, okay, this is really interesting. So, in other words, when bond yields went straight up, thanks to Bill Ackman, when bond yields went straight up thanks to fears of a second wave of inflation, bond market volatility was at record lows because the yields were just every day, it's like a roller coaster, the chain link or whatever. So where do we sit today? Right there. Bond yields have been basically straight up since J-Pow Day on September 17th. So it's been about 2 weeks. Straight up. Now, we have started to see a little bit of a boop, but that might be because of yesterday. We saw, bond yields fell because of the Iran or whatever. It's pretty minor. Had a little bit of a tick up there, and that's the 10-day average is the moving average that you like to use. If you go by the 3-day or 5-day, it's ridiculous. Use the 10-day historic volatility, and I think it gives you plenty of a heads up. So my argument here is I don't know what in the HE double hockey sticks is about to happen, but the bond market tells me something is about to snap. Okay? Now, I don't know if that's up or down. We're going to speculate about that. But something's about to snap. Now, I do want to talk about what my opinion is regarding this. But I do just want to quickly shout out that I am surprised how many people, when they get on a phone with my company, Stock Hack, are like, dude, we had no idea you could help us with our, advising on our trusts, our retirement, our real estate, our home, our leases, our tenants, our crypto, our businesses, business consulting, whatever. And I think, honestly, I've made a mistake. I think I have pitched Stock Hack as a financial advisor service, and people just think, oh, okay, you're some dude who's trying to beat the market. No, we're literally more like a life coach or a wealth coach is probably a better word, because I'm a licensed real estate broker, run a real estate brokerage. And we know how to do wedge deals. We could take somebody with a net worth, we believe, of 100K or 50K or 40K or whatever, and if we can help them buy a really good wedge deal, which there are plenty of, that's how House Hack was able to turn $50 into $60 million in like 1 year of operating, which is crazy. Then maybe that is, we got to figure out a better way to pitch that. So anyway, let me know what you think about that. But stockhack.com if you want to learn more about that. Book an intro call, it's free. But we can do a lot for every person that's called us. I look at these scenarios every single day and I'm like, okay, yeah, I've got endless things that I could help you with because it all comes back to me. Anyway, all right. So that brings us back to the right side of the board, which is how long? Okay, look, if the port strike resolves itself tomorrow and Israel does not attack Iran, or there's a lot of time between the attack, all right, cool. Maybe markets can just keep cranking up. Honestly, at this point, the jobs report for Friday is probably already priced in. We've probably already priced in the assumption that at this point we're just not going to have a bad jobs report on Friday. And that's likely because the ADP report came in strong and the JOLTS report came in strong. And so both of those together are probably suggestive enough for markets to assume, okay, the jobs report's probably going to be good Friday. So honestly, for me to suggest that unemployment claims is a catalyst tomorrow, it's not. The market might move off of it. You might be able to trade off it, but it's stupid. Or to suggest that jobs on Fridays are really going to be a big catalyst. No. And I said this a few days ago, like the market will try to trade off this stuff, but the real catalyst is going to come down to earnings. And this is where we have to ask ourselves, are earnings coming in bad at certain companies because they suck, or is it macro? Like, are iPhone deliveries expected to be down because they suck, or is it macro? Are restaurants performing poorly because they got greedy and raised prices too much, or is it macro? I don't know. But what I do know is that we have earnings coming up between about October 11th, and then we'll have CPI right after that. But October 11th to roughly the end of October, beginning of November, of course, then you got the election and everything. You have a lot of crazy catalysts. So not only do you have earnings, but you have the election. And then right after the election, you have the Fed meeting. And then you have jobs too, and CPI in there. So you've got this insane menu of catalysts here. And it's entirely possible that all of these things go great. Inflation comes in low. Everybody on average raises their earnings guidance. The port strike resolves itself. Iran resolves itself. The election FUD goes away. And the Fed's happy because GDP's looking good. Well, you don't have to be a bear. Then probably that low in volatility on bonds, it would be odd. But that low in volatility on bonds might mean that bond prices are just going to do that. Flatline for a bit. I don't think so, because the chart would suggest that you're about to have a big move in bonds. Given the prior two lows, I think bond yields are for some reason about to plummet because of the two prior historical times we've seen this. I don't know what the catalyst is going to be for it. I'm just looking at this chart going, this is odd. Something is about to happen. I don't think it is going to be an inflationary catalyst. I actually think there's a chance that you could do the following. And maybe this is what the bond market sees coming. I don't know. Maybe the port strike gets solved. The Iranian strike gets solved and they figure something out. I don't know. Maybe the United States gives Israel some money or something. Maybe the United States gives the Maritime Association some money to stipend these union workers. Now the union workers are happy and the Maritime Association is happy and nobody knows, but we just ran the money printer some more to solve this political problem. Cool. I actually wouldn't be surprised that both of those things are already in the works. That then kills the uncertainty of how long, which then kills the inflationary concerns of both of these issues, which drives yields down. But what else can happen is even with stable jobs, you still have massive election uncertainty. I wouldn't be surprised you get low inflation, and I do think you're going to get downward revisions on earnings, because even though companies say they're starting to see green shoots, this next quarter of guidance that companies are starting to give just seems to be negative across the board. Then again, maybe those are just, again, crappy consumer companies like Nike. Maybe they're just dead in the water, guiding revenue down 8 to 10% next quarter. Maybe Apple's phone just sucks, and that's why deliveries are expected to be substantially lower, and they're already canceling some manufacturing part orders because they don't need to make as many phones. Same thing goes for various other companies, and obviously we'll study the earnings as they come out. But whatever it is, my opinion, and I just want to be clear about this, is I think that yields are about to plummet. They could plummet because these issues get resolved. They could plummet because CPI comes in low. They could plummet because earnings come in weak. They could also plummet because there's some kind of shock. They could also plummet because the market decides to sell right before the election. But when this plummet happens, if this thesis is correct, when that plummet occurs, and when these uncertainties peak, I want to leave you with a word I have not used in a while. And I want you to see it. I want you to hear it from me first. Good luck, everyone.